from the College by the Lake, Coeur d'Alene, Idaho. Local, regional, national, and international guests discussing the issues and topics affecting the way you live are on Forum, the North Idaho College Public Forum, with your host and moderator, political scientist Tony Stewart.
We are very excited about this week's program, and next week we're doing a two-part series that we think has a very personal relationship to you, in the fact that finances is important to every family and every home. We're going to talk about financial trends and financial investment, both this week and next week. I'd like to explain how we break this up. On the first program, we're going to be more general in our discussion of the types of investment and dealing with stocks and annuities and different things that our viewers might be considering doing, or you may already be doing it. And then next week we want to look at some case studies in which we will talk about by age categories, in particular a young family or a family in which they may be retiring in 10 years, and what some of those case studies would show for you. We hope this will be as helpful to you as we are expecting. And in order to accomplish those goals, we're so pleased to welcome to our program Brad Dugdale. He is the Vice President and Branch Manager of D.A. Davison and Company, with his offices here in Coeur d'Alene, Idaho. I have known Mr. Dugdale for a long time, and I have great faith in his ability to deal with this subject. And Brad, it was kind of you to take this time to produce these two programs, and we very much appreciate that.
Thank you, Tony.
And I'm very pleased to have our two regular panel members. First of all is Janelle Burke, who is an attorney in the state of Idaho, and next to her is Steve Schenck, who is the Dean of College Relations and Development at North Idaho College. And I shall ask Janelle to commence our questioning on financial investments.
Brad, we're very excited today to talk about this, how to make money. And can you tell us, if a person had some money to invest, or even if they want to make a plan, how should you go about it? What kinds of steps should you engage in? What very elementary kinds of things should you begin with and follow through on?
That's a great question. One of the common mistakes that we see is that people walk into our office and they don't have a plan. And we'll spend a lot of time identifying what a person's goals are. One of the questions I always ask people is that 3 years from now, when you walk back in my office, what should have happened so that we know that we've done a good job? And most people will find that they have different types of goals. Some might be a short-term goal, or a medium-term goal, or a long-term goal. And thus, you can pick the proper investment strategy to accomplish each one of those goals.
Okay, I take it that one of the things you need to do is pick someone who is reliable and who might be able to help you with that. And so what are some of the investments that you could get into, the categories of investments that a person could get into?
Well, that's a good question, and there again, some of the categories that we see, or some of the goals that we see people trying to accomplish, might be purchasing a home or saving to purchase a home. A lot of them are to how to save money to educate children, and others would be retirement. As the baby boomers are maturing, retirement seems to be a popular topic right now. And there again, one of the things we try to examine is, depending on the length of the term of the goal, would determine the type of assets that they would want to own. So some of your common asset categories would be savings accounts, or money markets as they're commonly called. Another investment category are bonds, and there's government bonds and tax-free bonds. And then the other asset category is ownership of good companies. And so some people choose to invest in businesses to accomplish their financial goals.
Now, can some people, when they're investing in the market, so to speak, they might do that through mutual funds? Is that a kind of way that you might go about doing that if you were going to be investing?
Yeah, when I come back and ask people, I normally ask them if they're hands-on or hands-off. And if you're a hands-on person, then you can choose a financial professional, and the two of you can go out and pick individual securities for your portfolio. If you're a hands-off person and you really avoid your statements and you don't want to pay a lot of attention, then you can hire a professional manager by choosing a mutual fund, and that professional manager will go out and invest according to the prospectus, and thus you can choose a style of investment that would meet your financial goals.
Steve Sheen.
Brad, we're at least initially talking about trends today. As you look at the market in general, stock market in general, what percentage of the American public invests?
That's a good question. You know, if you go back through history, you'll find in the early 50s and late 60s that close to 40% of a household's assets were in stocks and financial instruments of that type. Now, we went through the 70s when there was a period of high inflation and short-term interest rates went high, and thus there was quite a transition from stock ownership towards fixed income and short-term accounts. And actually, towards the end of the 1970s, that percentage went down as low as 18%. Okay? Now that trend, because interest rates are declining, inflation is lower, that trend is increasing, and we're starting to see more and more people increase their assets in the household. And some of the estimates right now is it's about 27% of household assets.
Brad, we were talking just a little bit before the show, and we mentioned that one of the things that tends to get a lot of people into the stock market is retirement plans, investment plans, 401ks, and things like that. I would, in some respects, I look at those people as passive investors. Many of them may not even be completely aware of the fact that they own stocks as part of their investment portfolio. They're making a deduction from their paycheck every week, and they know that money goes somewhere, and they hope it makes more money for them in the long run. What percentage of the percentage you just gave us, at 27 or 28%, would you characterize as a passive investor, as opposed to those who really come into the into your office, know something about the stock market, and are actively involved with you in choosing their investments?
Steve, the fastest growing segment right now is retirement plans, and it's actually retirement plans for small business. Small business being anywhere from 5 to 100 employees. And they estimate that the growth of that is going to be exponential over the next 4 to 5 years. In fact, what's happening is that if your company does not offer a retirement plan, the employees are almost holding the employers hostage, because there's been enough information about Social Security, or the lack of Social Security, that is causing people to wake up and want to do something for themselves. And so a retirement vehicle is attractive because it does two things. One, it focuses on that long-term goal, but also as a tax avoidance strategy, which is popular with a lot of people. I don't have the specific number of what that is, what percentage, but I know that number is growing rapidly.
Tony, let me have one more quick question. Do you see a growing number of people who are coming to you because they're recognizing that Social Security won't take care of them in their old age?
Yes. Typically what's happening now, we're seeing people to where their children are now out of their home, they're having more discretionary income, and they're realizing that they have maybe a 12 to 15 year window, and their spending habits and patterns have changed dramatically. And thus those people are trying to figure out, how do I accumulate a nest egg to supplement my retirement?
Brad, you were very good to bring some charts or graphs with you for our visual learners, and we also want to look at, again, as we're trying to analyze the different kinds of investment, different kinds of categories, and one of those is called, I guess I would call it a performance graphic, and I want to ask our staff to put this up on the screen and have you to explain what this means. And I know that as you study the market and you study different investments, that this that's on the screen now will help you explain this.
Sure. You know, the performance graphic, I wanted to share this information because I think it's an important tool. There are approximately 4 investment categories. One of those investment categories is short-term cash, and that would be things like money market accounts or certificates of deposit. If you analyze those over 66 years of history, the average rate of return is 3.69%. The next category are bonds, and bonds, this graphic measures long-term government bonds, and if you look over a 66-year history, they have averaged 5%.
As we're doing this, Brad, would you on the screen identify for those who might not be able to see those clearly, which ones you're talking about?
Sure. Well, and in colors, the purple color is actually the orange color is the inflation rate over that 66-year period of time, and inflation's averaged 3%. The purple color is investment in short-term Treasury bills and money market accounts, and that's been the 3.69. The yellow line is long-term government bonds, and that's averaged 5%. And then we move into a different category. See, there's normally two things you can do. You can lend money or you can be an owner. And so those first categories we talked about is when you actually lend your money to someone else and they pay you interest. When you move to ownership and you assume the risks of ownership, the results are dramatic. And in fact, ownership over that period of time, large companies grew at 10.33%. And if you look at, and that's the blue line, if you look at the green line, and that's ownership of small developing companies, that grew at 12.36%. So if someone has a long-term goal, it's important that they're in investment categories that are going to help them achieve that goal.
But one interesting finding in your chart is really, really informative is that over this very long period of time, which is much more revealing than a very short history, is that all of these, although some are much larger than others, they all were above inflation rate.
That's correct.
And so, and of course, one of them was, the short term was 3.69, but a lot of people don't understand if they put their money aside and they're very, very cautious with it and have very, very low return, that it may not even keep up with inflation.
Yes. Well, actually, too, one other thing that we like to use is what we call the rule of 72. And that's where you divide your interest rate into 72, and that tells you how many years it takes to double. So, for example, if we were to use the rule of 72 with Treasury bills, and let's just assume they grew at 4% for round number purposes, if you divide 4% into 72, it takes 18 years for your money to double. If you were to choose to use large company stocks, and you take 10% and divide it into 72, then it would take 7.2 years for your money to double. So as financial planners, depending on the length of time someone has to invest, would determine which asset they should own in their portfolio.
Well, you brought us into the next chart that we're going to ask the staff to put up, and that has to do with time investment. And I know before the show we talked about this, and I talked with another investor, that short-term versus long-term has a lot to do with how risky that the investment might be. If they would put that up, then we'll have you to explain that, Brad.
Well, when you lend money to people, you get to use that wonderful word guarantee. And a lot of us have been trained that guarantee is good because we do not want to lose any money on our investments. When you become an owner, then you now subject yourself to what I want to call market risk, and that would be short-term fluctuations of your investment. Now, this graphic that we're using here is to show what time does, and time does a wonderful job of eliminating market risk. If you were to evaluate portfolios or if you were to own a stock and evaluate it in one-year time frames, 48 times it would be up and 20 times it would be down. So you had a 2/3 chance of being a hero and 1/3 chance of being a goat. If you look in 5-year categories, the odds start to skew to your favor that 57 times you are going to have a positive experience, 7 times you would not. And as you extend through the graph, that over 15 years, 54 times to 0. So that the longer you hold ownership, the higher the probability of showing positive returns in your portfolio.
And after 15 years, according to your table here, it was at 0 as far as...
every time has been a positive experience. That's correct.
And that was from 1925 to 1993.
That's correct.
Okay. So if you can, again, Steve suggests this in his question, if you can have money that you don't have to have, then you really increase your security with the investment.
That's correct.
Okay. one other question, then we'll go back to Janelle, and that is, if you are in bonds or certain types of simply getting an interest off your money, that is what one calls the safe category versus buying certain stock, even though this history tells us that that is not as risky as we first think it is.
Mm-hmm. Mm-hmm.
Okay. Janelle Burke.
Sometimes young people would like to invest, or even older people would like to invest, but they don't know how to go about saving the money in order to do that. What do you suggest? What kinds of plans do you have whereby people can begin to invest without a lump sum?
That's a great question. And in fact, there's a lot of companies, and you mentioned mutual funds before. The mutual fund companies, the way they make money is to manage money. And so they'll let you purchase shares. In fact, there's many funds out there that for as little as $100 you can get started, and then that you could voluntarily send in as little as $25 and add to your investment portfolio. Now, one of the ways I like to do this to use discipline is they will even let you have a deduction out of your checking account. And the clients that discipline themselves to have a certain amount taken out of their checking account every month, we call it pay yourself first, are extremely successful at accomplishing their long-term goals. If you do it voluntarily, if something happens to your car, well, I'm going to wait next month and then I'll do it. I mean, there's too many distractions that take you off your path.
Now let's take the opposite extreme where someone suddenly comes into some money and they have now a lump sum.
Yes.
How should they go about then getting an investment procedure that is going to meet their goals? What are some suggestions that you have for those kinds of people?
Well, it would depend on the person, and it would depend on one of the things we want to talk about is risk tolerance.
Yes.
And so I'd need to know a little more information. Why don't you give me a more specific example?
Okay. Let's say that this person is someone who wants to be in a medium risk category. They're not near retirement, but they're also not very young, and so they want to be somewhat safe, but then they don't want to be too risky, but they also want to have something that has some growth to it, some growth potential.
Yeah, I get a better feel for your question. What I would actually do, one of the things you do as an investment planner is you can actually blend investment categories. So for example, this person, I always say when you look at investments, how fast do you want to drive? Do you want to drive 45 miles an hour, 55 miles an hour, 65, 75, or 85? Now, it seems to me that you're describing someone that might want to go 45 miles an hour.
We want to follow the speed limit.
Yeah, that's right, 45 to 55. And what you can do is blend investment categories. So that person would want to have some bonds in their portfolio because they like the word guarantee, okay? But one of our greatest threats to long-term success is inflation. So we still need to blend that with some ownership in a portfolio of good, high-quality companies and common stock. So that person may actually have an asset allocation where they'd have 60% in the guaranteed category and 40% in the growth category. And when you extrapolate those returns, you're going to see a portfolio that should grow at 8 to 8.5 to possibly 9%, depending on what investment categories you choose.
Now, before the show, you used an analogy that I liked a lot, the one about the buckets, and you said that there are short-term buckets and there are long-term buckets, and people may have both in their investment procedure.
Yeah, and that's a great question. A lot of times people will come and say, well, I'd like to invest in the stock market. And I say, well, how long will you leave those funds? And they'll say, well, I have 1 year. And I say, well, I don't want to play the game, because if I have a 33% chance of that person not having a positive experience, why not put them in a guaranteed investment that 1 year they're going to walk in and we're going to know exactly what's going to happen. So if someone wants to do that, I wouldn't choose a risky investment category. Now, if someone said, I have 5 years to invest, and now we know that 57 times out of 64 times we're going to have a positive experience, would you be willing to take those odds? Those are odds I'm comfortable with.
One of the things you also indicated is that people might have their long-term investments, but they might also have some short-term investments just in case they needed to get their hands on their money. And lots of times families do need a little kind of nest egg that they know they can access. and you indicated that it can be a plan for that, whereby you have your long-term investments and your short-term investments. When the bucket gets full on the short-term side, you can move them over into long-term. Do you want to explain that in a little more detail?
Yeah. Well, one of the things that I personally do is I have a short-term bucket, and I keep enough money in an account. Some people say that you should have 2 to 3 months of your salary in a short-term account so that if you need to access it, that it's there. What you don't want to do is have to sell a long-term investment at the wrong time, okay? So you keep it there for emergency purposes. But once you have more than that 2 to 3 months salary, then what you have is you have too much money in a category that's only going to earn 3 to 4%. And depending on what your goals are, you may want that to earn 8 to 10%. So you would slowly transfer that from that low interest category into a category that would produce higher returns for you.
Steve Sheen.
Brad, let me back up just a little bit and do something I wanted to do earlier on, and I'm going to assume that fear is the biggest reason many people choose not to invest in the market, and I think more than fear of losing money, it may be fear that they simply don't know enough. So let me just get you to define some terms for us.
Sure.
And one that occurred to me as we were talking, I think most people understand what stocks are. That's that ownership position. I buy a piece of IBM or Boeing, and they understand certificates of deposit. It's a savings account, and I get a certificate that says I'm going to earn so much interest over a fixed period of time. What are these darn bonds? I mean, explain how those differ from the first two I mentioned.
Sure. Bonds can be issued by governments, municipalities, or by corporations. And from time to time, the municipalities and governments and corporations like to borrow money, all right? And so what they will do is actually sell bonds that will have a specific rate and a specific length of time. Now, the United States is selling bonds every week, and one of the bonds that's followed is the 30-year Treasury bond. So, for example, what that would mean is the most recent bond, I think, had an interest rate of 6.5%, 30-year term. So anyone that put $1,000 would be guaranteed to get that $1,000 back at the end of that 30-year term, and every 6 months they would receive an interest payment for that 6-month period of time. Those bonds will increase and decrease in value with interest rates.
Tell me what a mutual fund is.
A mutual fund, Steve, is where a professional manager will manage a pool of money for shareholders. There are actually two types of mutual funds. One type of mutual fund is what they call an open-end fund, where as money flows into the fund, they just create more shares, and every day they figure out the value of those shares, and you may see those on Saturday mornings in the paper. They have a thing called the net asset value, which shows the value of those shares every Saturday morning. The other type of fund is what they call a closed-end fund, which are traditionally listed on an exchange like the New York Stock Exchange, and they're a fixed number of shares, so that they will only offer those shares at one time, and then those shares will trade in value according to supply and demand.
How about the term yield, Brad?
Well, yield is commonly used to determine the cash return on an investment. So, for example, stocks would provide a yield if they pay a cash dividend, and bonds would provide a yield, which is that stated rate of return on the value of that investment. So, yield is commonly used to talk about the rate of cash that's distributed on a particular investment.
And one last definition, the term no load.
Well, actually, there are mutual funds that offer help, and then there are mutual funds that are kind of self-service funds. So I call them help and no help funds. And if you choose to work with an investment advisor, most of the time you're going to pay some type of service fee for that professional's advice, okay? If you feel comfortable enough to do that on your own, there are companies out there where you can send your money directly into the mutual fund company and purchase those shares and not pay for that service.
And Tony, if I've got time for one more question, I want to get back to trends. I liked the last chart that you showed, the one that showed that over a 70-year period, for any 15 years you were in the market, that there were no instances where you would have lost money on your investment over that 15-year period. And I think that's a powerful argument for owning stocks. But the next 70 years may not be exactly like the last 70 years. And in terms of trends, do you see anything in the future, emerging technologies, which make the question of competitiveness more and more important to businesses? They come and go more rapidly than they used to. The trend toward globalization in the marketplace. Any of those trends scare you a little bit, or say, conversely, that the stock market is going to be an even better place to be over the next 70 years?
Well, I think what you're asking, Steve, is, will economics change? And I have gone past even the 70 years we've seen. You can go back in the 1800s. And the big difference in investments is lending and owning. And there seems to be about 5 percentage points difference between whether you're a lender or an owner. So do I think that over the next 70 years that there'll be a dramatic change in the rates of return of being a lender and owner? No, I don't. I think that these investment categories will perform at about the same rates over that period of time. It's just that there's economic circumstances that can make one look more favorable versus the other over short periods of time, but over long periods of time, these numbers will bear out.
And I think your answer suggests also that if you go back 100, 150 years, we had dramatic changes, like we will continue to have dramatic changes in the future, but still the market somehow, and how you invest adjusts to that.
Well, I'd like to draw something on here, and
I'm going to have to interrupt to say we're not going to have time in this particular program. If you could just quickly answer that, and then for the viewers who come back next week, we will do that.
Well, could you repeat that question,
Yeah,
Tony?
I'm just simply saying that over the last 150 years, we've had dramatic changes in technology and so forth, and you're saying the market adjusted for that. Can we assume that will happen with these drastic changes, that history points to suggest that there won't be that change?
Well, one of the most dynamic investments is business. Because, business can adjust to just about any economic condition.
On that note, I have to bring the program to conclusion. But the good news for our viewers is that Brad Dugdale will be back with us again next week with our panel. And ladies and gentlemen, we will be fortunate enough to get answers to this and some other questions next week. I hope you'll join us when we look at some case studies. Until then, please have a good week. I am Tony Stewart.
The North Idaho College Public Forum was videotaped live from the studios of Instructional Technology on the campus of North Idaho College for viewing at this more appropriate time. We invite you to join us again next week for another all-new edition of the North Idaho College Public Forum on this public television station. From the College by the Lake, Coeur d'Alene, Idaho. Local, regional, national, and international guests discussing the issues and topics affecting the way you live are on Forum, the North Idaho College Public Forum, with your host and moderator, political scientist Tony Stewart.
Welcome back to part 2 of our 2-week series on financial trends and financial development. And for our viewers who were not with us last week, our guest is Brad Dugdale, who took us through a lot of the terms and the types of investment last week, and we're going to continue that. But today we're also going to do 2 or 3 case studies. If you're 30 years from retirement or 10 or near retirement, the kind of things that you might do that would make the maximum amount of use for the funds that you have for retirement or other things that you might be planning. Our guest, as I've indicated, is Brad Dugdale. He is the Vice President and Branch Manager of D.A. Davidson & Company with his offices located in Coeur d'Alene, Idaho. Brad, it was such a very informative program last week, and we're so happy to have you back to continue to try to help our viewers with the financial interest that they may have.
Thank you, Tony.
And as always, I'm very pleased to have our two regular panelists, Janelle Burke, who is an attorney in the state of Idaho, and next to her is Steve Schenck, who is the Dean of College Relations and Development at North Idaho College. And we're going to change the rotation a little bit. Brad, I'll start out with the first couple of questions this time. Janelle usually does, but as we went off the air, I cut you off. You were getting ready to show our viewers through the board that you have there a little bit about my question. You had indicated that if we look over the last 65 years or so, that we see that the longer you invest, the safer your investments. And Steve had asked a question concerning, well, with all the change in technology and rapid changes all over the world, would the next 70 years be as safe and those kind of statistics as the last 60 or 70? Would you indicate to us why you're optimistic? I'd indicated that in the last 150 years there have been a lot of changes, and the market and other financial institutions adjusted to that. With that background, would you elaborate on the question and show our audience why you continue to be optimistic?
Sure. It's a great question, and we're always trying to predict the future, but it seems that economics don't lie, and they have remained fairly consistent. And the way we divide that is between ownership and lending, and we were talking about those rates of return. One of the things that's frustrating with ownership, and especially with the stock market, is that people have emotional ties to their money. So there is fear and greed. And just to move over here to the board, I just wanted to show you that if we drew a line and it were to grow at 10%, okay, and this is our chart that we saw in the last show, that actually greed, when you go above the line, fear, greed, fear. If you look at these cycles, we always move to extremes. And I hate to always pick on Dan Rather, but Dan can do an excellent job of exciting us into the market, but 18 months later could do an excellent job of scaring the daylights out of us, okay? But if you think about your business, did the business physically change? I mean, one investment that I talk about frequently is that even right now in this, as we're taping the show, how many people are going through the drive-thru at McDonald's? And so even though we may be having a recession, okay, did the intrinsic value of McDonald's go down, or did our perception of the stock market change the price of McDonald's? And so you'll see these trends. In 1994, a lot of people were fearful. Now the market's gone up, and people are now saying, well, you know, that stock market's not too bad, and I'm looking at my statement, and things are pretty good. And typically then people start to become attracted to the market, not when it's actually at its low, because at that time they're fearful. They normally get attracted in these segments of the market just as they're about to experience the next contraction in the system. But the important thing to remember is this line, because that's the line that you're choosing that particular investment category.
But out of fear, some people will buy high and sell low.
Oh, absolutely.
And that's called a loss.
That is. Well, and that's the value of using an investment advisor, because typically when you're feeling greedy, you're normally doing it because your neighbor has made a lot of money, and they're telling you about, oh, the technology stocks that they've owned, and so now you want to call and get into technology, when typically that cycle's about to turn.
I got a couple more questions. One of them has to do with individuals who are investing in fixed investment with an interest. I mean, their money is safe, but they're getting an interest, and they may get in when the interest, that was a long time ago, was at 12 or 14% for them. Now they're down to 5%, some of them in that area. Would you kind of explain the difference in that and how that fits to inflation? Even over the long run, could they not have some concerns over the most unpredictable economic statistic, I would suspect, over a long period of time is inflation, is it not?
Yeah. Well, Tony, in fact, you're actually highlighting one of my greatest fears. Everyone wants you to make a prediction. And if I were to make a prediction, I'm going to predict that interest rates are going to go lower than most people believe. And if you go back and study history over long periods of time, interest rates are a direct relation to the inflation rate in an economy. So that historically there's a 2 to 2.5% inflation premium. And what that means is if we use our example over the 66 years, if inflation is 3%, if you add 2.5% to that, then that means your long-term interest rate should be 5.5%. When you go back to the early 80s, when interest rates went as high as 15% on short-term money, the inflation rate was 13%. And so you take your 13%, add your 2% inflation premium, and there is your 15%. Now, one of the things that we see is that inflation is declining through productivity. Technology has made us all more efficient, and thus companies do not need to raise prices. The other global trend that we see is in America, the baby boomers are retiring. And we call it the yuppie to nerd ratio, okay? When you're a yuppie, you're out spending. When you're a nerd, you're now starting to save for retirement. And we now are having more of the baby boomers move from the yuppie category to the nerd category as they go out and start to plan their retirement goals.
One other question then to Janelle on the case studies, but something else that if you're in certain professions and occupations, you can participate in annuities, and it's federal law. The government allows you to go into a lower income bracket for tax purposes. And so the money that you're investing, it's part of yours and it's part in taxes that have been postponed. How do you react to what another consultant said to me, that one of the greatest kinds of investments is being able to use someone else's money for investment?
Well, we haven't talked a lot about tax deferral, but tax deferrals is one of the best strategies. And one of the things is we're helping people plan their financial futures is we'll ask what mode of employment they have or whether their employer has a retirement plan vehicle. If they do, I mean, that's an integral part to any successful retirement plan. So in your case, you know, in fact, one of the best plans available for people in United States government and hospitals are what they call a 403B plan. And it gives you the right to actually defer some of your income right through your paycheck into annuities or mutual funds. It used to be with 403Bs you could only choose annuities. Now they've expanded that to where you can actually choose mutual funds. But that is a hallmark because, as we talked before, the successful clients I have that execute their plans are the ones that do it automatically. So if it comes out of your paycheck and you don't miss it, that's the best type of savings vehicle out there.
Okay. Janelle Berg.
In preparation for today's show, you did some case studies. So can you share with us, please, what would happen if a person who was young, about 30 years old, began to put away a certain amount of money each month in some kind of an investment program?
You bet. Albert Einstein said, the eighth wonder of the world is compound interest. And the financial numbers truly demonstrate that. I ran a case study on a 30-year-old person that was able to budget $100 a month or $1,200 a year. And that person invested in the investment category that grew at 10%. So they were willing to drive 65 miles hours of funds and take a little more risk and volatility. But that particular investment strategy over that 35-year period grew to $365,000.
At the time of retirement?
At the time of retirement.
At age 65.
Now, just to clarify a couple things in our case studies, this person, we ran a hypothetical income of $30,000 a year, so it could be a couple with that combined income that would dedicate $100 a month. And they traditionally say that at retirement, you actually need approximately 70% of your retirement income, because typically at that time you may have paid for your home and your spending habits are a little lower. If you choose to have children, your children are out of the household, and it just doesn't take as much to live. And so one of the things that we worked on in the case study was to try to make sure that they had enough retirement assets that they could actually maintain a lifestyle above inflation. The $365,000, if they were to start taking 7% of that each year in the form of income, would supplement their Social Security to the tune of about $3,600, and thus the combination of that investment and their Social Security would actually maintain their needs higher than inflation. I want to just share one dramatic thing, and I know you're not expecting this question, but I did want to show the power of compound interest. And I also ran a study on someone that was age 22, and said that if someone was at age 22 and fortunate enough to start saving that $100 a month, how much those assets would grow. And I guess I'd throw a question to the panel. We know that the person at age 30 was able to accumulate $350,000. If you were to guess how much the person that started 8 years earlier, how much money do you think would they have accumulated?
I'll guess around $500,000.
Actually, that's close. The number was actually $783,000.
Wow.
And so what happened was the person that was able to start 8 years earlier was able to generate more than double that period of time. And that's the power of compound interest. I mean, that's a substantial amount. That's almost an additional $400,000 by starting at age 22. If you do the math, that's $1,200 a year times 8. So that person only put in an additional $10,000, but it generated $400,000 worth of additional principal over that period of time. And the reason that happened was the value of time. They started 8 years sooner than the person that was age 30.
Now, I know that you also have a case study for people who are closer to retirement, and there are an awful lot of our viewers, I'm sure, who are out there in that category. They're much closer to retirement. So can you share with us the details of those kinds of investments?
Well, Tony had kind of prompted me, and Tony had said that, and actually there are baby boomers getting ready for retirement, and don't throw your hands up in the air and quit, because, you still... I mean, the sooner you start, the better off you're going to be. I would love to tell you that the numbers are as dramatic, but they are not. What we worked on was a case study of someone age 50 with a retirement goal of age 65, and if they were to dedicate $2,000 a year to a savings plan, or about $166 a month. Now, the reason I chose $2,000 is that we always have the opportunity to fund an IRA investment here in the United States. And so everyone's entitled to a $2,000 contribution in their IRAs. But that amount of money over that period of time would grow to $71,000. And if you were trying to supplement your monthly income, it would provide an additional $400 a month without actually using your principal. So if you're out there trying to do some planning, Social Security for that person should be approximately $2,200 a year at age 65, and then you would have that additional $419 of supplemental income. Now, just to augment to that, I ran a study because a lot of people that walk in my office, they at age 50 kind of move into panic mode, and they kind of go, well, we can cut back on this and cut back on that, and so we've figured out a way to save $500 a month. Our children are gone, or our house is paid for, our boat. And if someone were to start saving $500 a month, they would actually be able to accumulate $215,000 over that same period of time. And that would produce $1,200 in additional income. So that, that gives some hope out there that if you've been putting off or procrastinating a little bit, there still is a chance that you can do that. And you can do that in an IRA or some other strategy where you wouldn't have to pay any income tax or defer it.
Steve Sheen.
Brad, I want to talk a little bit more about the concept of diversity in an investment portfolio. But first, I I have to know if Albert Einstein really said that the eighth wonder of the world is the power of compound interest? Or
Yes.
is that that's not a stockbroker joke?
No, that's not.
All right. I'll add that to my list of quotables then. Diversification. Let's talk a little bit about it, about how important it is in a portfolio regardless of age, and what you consider to be, and I know it varies from person to person, risk tolerance to risk tolerance, and at different stages of their life, but what do you consider to be a good, well-diversified investment portfolio?
Well, that's a broad subject depending on whether you choose to use individual assets or you choose to use mutual funds. Mutual funds have become more and more popular. Interesting enough, it's funny how people forget things. Back in 1974, if you were to mention the word mutual fund, I mean, you would be tarred and feathered, because when we went through the oil embargo, mutual funds had horrendous performance, okay? And even when I started in the business in 1982, I mean, I'd mention the word mutual funds and people would say, oh my gosh, my father had one of those and we promised we would never buy one of those mutual funds again. 30 years later, guess what? I mean, the rage is everyone wants to own mutual funds. So it's interesting how things go through cycles. Now, I'm not trying to avoid your question. Let me answer it. One of the tools that I like to use in helping people do financial planning is to subtract your age from 100, okay? And if you subtract your age, let's say that we were working with someone age 50, then how we would choose to do that is that 50% of your assets would be into a growth category and 50% would go into the fixed income category. Now, if you were younger and you were age 30, you would dedicate 70% of your assets to the growth category and 30% of your assets to the fixed category. In fact, even if someone were age 75, okay, you would have 75% of your income in the safe, guaranteed categories and 25% into the growth categories. Now, the reason that formula works very, very well is that we're always going to be subjected to inflation, and the growth category always protects your investment against inflation, okay? So one of the ways you can diversify is through investment category, all right? If you're choosing mutual funds are diversified by nature because typically the investment manager cannot hold more than 5% in any one investment. So they're forced to be diversified by nature.
And when we talk about growth category, we're talking largely about stocks. And Tony, I've got my eye on the studio clock here, and there's a question I've got to get in. I'll warn the audience that this is the time to go get your paper and pencil out. It's always fun, like you said, to make predictions. Tell us what you think some of the better stocks on the market today are. What are your personal picks?
Well, part of that depends on your philosophy. I like to use a lot of common sense and use trends that you can hold on to for a long period of time. One of the trends that I have been using over the last several years is companies that buy their own shares back. The board of directors may feel that their company is undervalued compared to what they would be worth 5 years from now, and if they have extra cash, one of the best things they could do is to retire the number of shares outstanding. So by retiring shares, it automatically enhances the value of all the remaining shares. Some companies that are doing that right now, one is General Electric. General Electric has made a commitment to buy back $5 billion of their outstanding shares, and the earnings have been growing at 12% a year and is paying a 2.5% dividend. Another company that's doing that is McDonald's. And McDonald's is so far bought back $2.6 billion of their outstanding shares, and I will venture to guess that they'll continue to buy more back. Just to give you some statistics, Coca-Cola was the best performing company during the decade of the 80s as far as the Dow Jones Industrial Average was concerned. And over that decade, they retired 25% of their outstanding shares, and that company increased in value 400% over the decade. So the power of retiring your shares is very wonderful, and it tells you that the board thinks they're undervalued.
Well, Steve, I know you're a hero with our viewers. I even say that word may get out to watch more often. When you mentioned in answering Steve's question that 12, you were talking about a company with having a 12% increase per year, and then you mentioned 2% dividend. Explain that to our viewers. In other words, can you engage in the purchase of stock in which the stock is going up, but in addition to that, which is, you're not drawing that money out, but then you're also getting a dividend in addition to that?
Yeah. Well, let's use General Electric, for example. General Electric, over the last 12 years, has raised their cash dividend every year. And what that means, if you're a shareholder of that company, that they're actually increasing the amount of cash that they pay you every quarter. Most corporations choose to pay a dividend on a quarterly basis, so every 90 days you're receiving some cash in the mail. Now, besides that, you look at the rate of growth that the business is growing. And one of the ways that you measure that is through what they call earnings per share. So if a company is growing their earnings per share by 12%, then historically you could watch the value of that company increase 12% a year.
Another thing is that when people are trying to figure out how they're going to do this, and most people are, like Steve suggested that he does, that they don't want to deal with this daily, and they get a financial advisor. And like we get into mutual funds and investment, there are private organizations that rate them, and also there's certain laws in which you have a right to know how well they're doing. Could you explain to our viewers how they're rated, or I believe there's something like 5-star and 4-star, so forth. Explain that so our viewers could look up in certain publications that's another tool that they would use.
Yeah. Tony, one of the things I want to emphasize in this whole process, because picking the investments is the fun part, but I do also want to re-emphasize that make sure that you're very clear on what your goal is, and make sure that you're always picking investments that match your goals. One of the common mistakes that we see made in the investment community is that you buy the investment of the month. So you have a certain amount of money and you buy it because it sounded good, and after 10 years you look at your investments and say, oh my gosh, I have the investment of, what does your portfolio mean? Does it meet your goals? You really don't have any idea. Now, what happens is there's tons of rating services out there. Okay. And I think rating services actually create full employment for my industry because they create more confusion. And so whether something's 4-star or 5-star is important, but more important, does a 5-star fund match your goal or doesn't it?
Okay. And so it's kind of like going to, we've done shows with some medical doctors and say that you need to come in and you need a history of your health and so forth, so your family physician can know how to deal with it. Very similar in financial statements, that there really needs to be, I hear you saying, a history of what you have and what you want and how you might maximize that.
When people get started, their ego wants them to earn the highest rate they can without having concept of risk. In a break, we were talking about emerging markets, and we can make a wonderful case, and Wall Street's wonderful at hyping up something, and there again, typically, and just moving back to the board, typically when you start feeling the hype, when is it coming? Is it coming when it's low? No. It's coming when it's high, and you're normally setting yourself up for some degree of failure. So that's where keeping the, most people can accomplish their goals in extremely conservative investments, and so why take the risk?
One other thing before we go back to Janelle, I've talked to some people who retired recently, and they take a look at their Social Security and these investments, and they have some options of how much they want to draw out a month and so forth. But one of the advantages they have too, there is certain funds that they're drawing upon, they've already paid taxes on it, and so in other words, even though your income may be somewhat smaller per month than when you worked, you also don't have some of the same obligations in taxes and so forth. Mm-hmm. Is that correct?
Yes.
Depending on what you've done.
Yeah, the ideal portfolio, in fact, when I retire, my portfolio will look like this. I will have a portfolio with asset classes that grow at 9%, but I'm going to take only 6% in the form of income, so that every year 3% is going back into the pool, so that next year when I take my 6%, I'm going to get a pay raise. And that's a great way to factor in inflation. So my goal when people retire is a conservative portfolio that grows at 9. We're going to take 6 out in the form of income, but always throw 3 back so that next year we're taking in account the rate of inflation.
well, how do I know when I'm going to buy and when I'm going to sell? And one of the things that people often think about when they're talking about the market is I'm going to have to get into this, and then I'm going to have to make a decision when to sell, and how will I know that, and so forth. But during the break, you were indicating that perhaps it is a long-term investment, and we should be thinking about this in terms of ownership, as you would in any other business. Do you want to explain to our viewers about that?
Yeah, that's a great question, and I would answer it in two segments. One of the simplest ways to invest, and moving back to the board here again, is through a process we call dollar cost averaging, to where you're putting regular chunks in the market so that over time you actually spread the risk of ownership. And if you can see that if the line is higher, dollar cost averaging is a great way to make sure that you're always buying shares when they're low. And when you're buying shares at the high, you're buying less shares at that period of time. So as a function of math, it's a great strategy. And we were also talking about if you're going to own a business, if you were to own a local business in your community, you're not going to own it for 12 months. I mean, you're going to own it for a long period of time. And if you think of your equity and stock investments that way, you want to own businesses that will be beneficial over a long period of time.
On that note, we have to bring the program to conclusion. I'm glad we got the board done this time before we close. On behalf of the panel and our staff, Brad Dugdale, we thank you so much for being with us these 2 weeks. It's been extremely informative, and I am most hopeful and sure that it's helped our viewers. Ladies and gentlemen, our guest has been Brad Dugdale, the Vice President and Branch Manager of D.A. Davidson Company in Coeur d'Alene, Idaho. We've had 2 weeks talking about financial investment, and I'd like to invite you to be with us again next week at this same time when we'll move to yet another important issue. Until then, please have a good week. I am Tony Stewart.
The North Idaho College Public Forum was videotaped live from the studios of Instructional Technology on the campus of North Idaho College for viewing at this more appropriate time. We invite you to join us again next week for another all-new edition of the North Idaho College Public Forum on this public television station.